I'm going to say this plainly. The mortgage conversation in Canada has become detached from reality. For 2 years, the story was simple. A massive renewal wave was coming. Payments were going to explode. Forced selling would follow, and prices would crash. That was the story, and it didn't happen. The mortgage renewal did not crash the housing market. It trapped most Canadian homeowners in a position they cannot easily exit. The trap is not a payment, it is worse than a payment. Before I go through it, I sell real estate in Metro Vancouver. My name is Dan Reilly. I read the Bank of Canada policy notes. I read the mortgage and renewal data from the major banks quarterly. I sit at the transaction level with buyers and sellers trying to move. Everything you're about to hear is math and data, not opinion, not prediction. Let us start with what actually happened. Yes, some of the households did see payment shocks, specifically households who locked in 5-year mortgages at the absolute bottom of the rate cycle in 2020 and early 2021. Rates at 1.59 to 1.94%. Those exact borrowers came up for renewal in 2025 at rates around 5.44%. That is a real jump. For a $700,000 mortgage, roughly $1,500 more per month. That number sounds catastrophic, but look at the same group closer. Those borrowers paid down principal for 5 years. They built equity. They had 5 years to prepare. Most of them refinanced before renewal, extended amortization, or absorbed the increase. They did not sell, they adjusted. Meanwhile, a bigger group of borrowers took shorter term fixed mortgages during the rate hiking cycle. 2-year fixed at 5.99%, 3-year fixed at 5.49%. Those borrowers are now renewing into 3.79% 5-year fixed. Their payments are going down, not up. When you add the whole system together, the median renewal impact was close to flat. Not catastrophic, not destabilizing. The renewal wave did not crash the market, and the narrative was oversold. Look at the actual Bank of Canada data on this. In their most recent financial system review, the bank reported that the average mortgage renewal payment increase across the entire country was under $200 per month. Not $1,500, $200. That is the median. That is the middle household. Some paid more, some paid less. Some renewed into lower rates and paid less each month than before. The bank stress test found that the vast majority of Canadian households could absorb the higher renewal rate without forced selling. They had home equity, they had savings, they had budget flexibility. The wave was real. The crash it was supposed to cause was not happening. Here's the part a lot of people didn't explain. The renewal wave failed to cause the crash, but the way it failed created a new trap. Bank of Canada cut rates. Lenders got creative with extensions. The federal government backstopped condo prices with a $3.2 billion bailout. The wave was diffused, but diffusing the wave did not fix the market. It just froze it in place. Now you have hundreds of thousands of Canadian homeowners who are stuck, not in a payment shock, but just in a position they can't easily exit. That's the real trap. Let me show you 4 moves you cannot make right now. Move 1. Refinancing up to pull equity out. A lot of homeowners built their financial plan on the assumption that home equity would keep growing. Money for business, money for retirement, money for kids' tuition. The plan was to pull equity every few years. That plan is broken. Home values in Metro Vancouver have moved sideways to down for 3 years. Some pockets are down 15 to 25%. If your equity did not grow, you cannot refinance up. The move is frozen. Move 2, selling to unlock capital. A soft market with long days on market means selling takes longer. You either accept a discount or you sit on your listing for months. Many households need the sale proceeds for something specific: a relocation, retirement move, a divorce, a business investment. That specific need does not care that the market is soft. If you have to sell into a soft market, you eat the discount or you delay the plan. Either way, the move is frozen. Move 3, upgrading to a bigger home. The spread between what you own and what you want to own has widened. A $1 million detached 10 years ago upgraded to a $1.5 million detached. Difference of $500,000. Now the $1 million home might be worth $800,000 and the $1.5 million upgrade might be worth $1.2 million. The nominal spread looks smaller, but the cash required to close the gap is much bigger because interest rates are higher than a decade ago, because appraisal buffers are tighter, because down payment rules have changed. Fewer households can execute the upgrade. The move is frozen. Move 4, downsizing without losses. Retirees who plan to sell the family home and downsize into a condo are looking at condo values that are also down. The math does not work. Sell high, buy lower did not survive the last 3 years. A lot of retirees are choosing to stay put, not because they want to, because the numbers no longer work. The move is frozen. There is a 5th frozen move, cross-city relocation for work. If you own in Vancouver and you get a job offer in Calgary or Toronto, you have to sell in a soft Vancouver market. Then buy into whatever market you land in. If both markets are moving in the wrong direction for you, the math kills the move. Statistics Canada tracks interprovincial migration. BC saw negative net migration for 2 straight years. That is not people leaving because they hate Vancouver. Many of them are staying because they cannot execute the move. Trap is not just financial, it's geographic. So here's where the real damage lives, not in payment shock, in a mobility collapse. The mobility collapse has no headline number, so it does not make the news, but it changes how a country actually works. It changes career decisions. It changes family decisions. It changes retirement plans. Let me show you the data. Greater Vancouver residential transaction volumes are down over 30% from the long-term average. That is not a small dip. That is a mobility collapse. When transactions drop that much, 3 things happen at the household level. 1, people stay in homes that no longer fit their lives. Growing families in homes that are too small. Empty nesters in homes that are too big. Divorced couples in homes that cannot afford to split. 2, career-driven moves get postponed. Job offers in Toronto or Calgary or the US get declined. Not because the offer was bad, because the housing math on both ends does not work. Buy high, sell low is the opposite of what most households need. 3, retirement plans get delayed. Boomers who plan to sell and travel are staying in the family home, not by choice, because the downsize math does not work. Those 3 things together are the mobility collapse. Each one costs a household something they cannot get back. Time with family, a career opportunity, a retirement dream. There's a name for a market that traps people in the wrong home, a frozen market. Not a crash, not a boom, frozen. Here's the part that changes how you think about your home. If you're stuck in this trap, waiting is not free. Each year you cannot move, you're paying an invisible tax on your career, on your family, on your options. Waiting does have a cost, and the cost compounds. Let me tell you what your options actually are. If you need to sell, don't wait. The market is not going to reward you for waiting 6 months. Price your home aggressively to the current market, get sold, move on with your life. The mobility cost of waiting is bigger than the discount you would take. If you can hold with runway and 24 to 36 months is realistic, do not accept a discount you do not need to accept. Wait for the compression to resolve. Meanwhile, it's probably better to hold. Absorb the frozen market cost knowingly. If you're a buyer, the opportunity window is right now. Sellers who need out are pricing aggressively. The best deals are in the pockets where sellers do not have runway, not the pockets where investor stock is bleeding. Those are the trap pockets. The buyer opportunities in the pockets where owners with real fundamentals have to move. If you're already in a home that no longer fits your life, run the numbers on staying versus moving. Include the mobility cost, include the opportunity cost, include the family cost. If moving still wins, price aggressive and get out. If holding wins, commit. Do not sit in the middle waiting for your market to decide for you. If you're an investor holding a cash flow negative rental unit, the math probably changed twice on you. Rate renewal added to the payment. You're now bleeding cash monthly. Run the honest calculation. Total the monthly cash costs, including strata, taxes, insurance, and vacancy allowance. Compare it to your best case rent. If the gap is real, it's not a temporary problem. Rents are going to stay soft in the pockets we discussed for another 12 to 18 months most likely. If the gap is under $200 per month, most investors can absorb. If the gap is over $500 per month, it's a bigger decision. Selling into a soft market to stop the bleed is not defeat, it's just math. Either way, a pretended is fine plan does not survive another 18 months. The Canadian housing market is not crashing, it is not booming, it's just frozen. Frozen markets do not heal on calendars, they heal on incentives. Rates have to fall further to unfreeze upgrades. Prices have to move to unfreeze downsize. Confidence has to return to unfreeze cross-province moves. Sellers have to accept the new reality to unfreeze the transaction flow. Each of those catalysts is possible. None of them is fully here yet, which is why most Canadian homeowners are stuck. Not because they're underwater, but because they cannot move. The renewal wave did not trap them with payments. The response to the renewal wave trapped them with stasis. That is the story headlines missed, and that is the story that decides your next move. 3 ways to work with me from here. If you have a specific Metro Vancouver property on your radar, shoot me a text at 604-288-7592. Send me the MLS number. I can pull the comps. I can run the math. I will tell you where the opportunity could be or where the trap might be. If you want to see some of the best deals I've vetted personally, click the link below in the top 3 deals. Real motivated sellers, real value, none of the frozen pockets. And if you want 30 minutes to walk through your specific situation, if you're stuck in the trap and trying to figure out which move is right for you, you can book a Zoom with me and we can map out your path. Quick note, this video is general market commentary, not personalized or financial or investment advice. Talk to a licensed professional before you make any moves. Thanks for watching, and I'll see you in the next one.